Welcome to Commercial Real Estate Podcast powered by First National. I am Adam Pawadic, here with Aaron Cameron at the end of the RealREIT conference. This is part of our speaker video series sponsored by Granite REIT, and we thank them for that. Our final guest of the day is Gordon Wadley, COO of Dream Office. Welcome.
Yeah, thanks a lot for having me. I'm looking forward to it.
Yeah, this is a topic obviously that probably gets mentioned quite a bit at every single conference, regardless of asset focus. It's made a lot of headlines in the last little bit. The turbulence obviously is very well publicized. So we're looking forward to the conversation because obviously coming from a group like Dream, strong office operator, how are you navigating the turbulent waters? What's making sense? What isn't? We're looking forward to the conversation. But welcome.
Yeah, thanks very much for having me, Adam and Aaron, and looking forward to being a part of the conversation. There's been no shortages of questions around the office arena. I think we're really fortunate at Dream. We own and manage in core markets across the country just over 5.5 million square feet. Predominantly 85% of our $2.7 billion AUM is in Toronto. So we've got pretty good sight lines to what's happening in the market.
And how happy are you that it's almost entirely core? Because I know some of the suburban stuff has that extra layer of difficulty to work through.
Yeah, great point. And as a manager and as an operator, I'm very happy that it's core Toronto. There's a huge juxtaposition in terms of sub-market quality and the type of deals and the cost of deals and the velocity of deals. They change a lot sub-market to sub-market. We have assets in Ottawa. We've got assets in Calgary, and it's a bit of a different story than it is in Toronto.
Is Yonge and St. Clair core?
Yeah, I would say so.
Okay.
Yeah.
Just curious.
Yeah.
Just asking.
Yeah.
No reason.
Yeah.
It's a messy space you're in right now. Like there's no way around it. And
it was the darling space in 2019. I mean, it was the lowest vacancy rate.
Well, it has been for decades. I mean, we've had we've had lots of people from Dream. This year, the first Dream office guest on, but we've had lots of other office focused people and others that are office adjacent but have their history in office. And office has been the darling of commercial real estate since the 80s, and then for a blip there, but then after the bubble .com burst, like office was back in. Like it's always been kind of the most
it makes the cover of
I
the
want to say I want to say sexy. It's like the sexiest office class, right? Is that fair?
I've never been lumped into that kind of classification, but it was pre 2020. It was a darling asset class to be a part of, and I hate talking about it, but COVID happened. Seems like so.
We all hate talking about it.
Yeah.
Yeah.
And it was a real inflection point for the space. People realized they could work from home, and demand went down, and values went down.
Government started announcing, we'll never have you back in the office again.
Yeah. Big tech was running away in droves as well too. But I honestly, fellas, if I'm being candid with you, I think we've hit the trough in the office market. And, I'm always kind of cautiously optimistic, but now I like to say that I am optimistic. We were meeting with investors last week, a lot of them with funds in the U.S., and they seem quite bullish and cautiously optimistic on where the trajectory for Canadian office is going.
Is that because enough leases have rolled? I mean, I disagree, but I'm not an expert, so what the hell do I know? It always seems to me like you have to have at least 5 years. Maybe we're at that point, but probably more like 6 or 7 for enough leases to roll in the existing hybrid working environment to know what true rents should be before you can start making assumptions on where we're going in the future. And are we there yet? I mean, I know you're very gently tipping into the optimistic camp, so maybe you're still kind of debating that.
Yeah, what gives me optimism is we haven't seen a dip in our net rents over the course of the 5 years. It's been totally different. If you look at our results, we've seen quarter over quarter consistently growth in our net rental rates. Where we have had a hard time, and it's not so much a demand issue, but where we have had a hard time is net effective rents. So net effective rents are your effective rents after total gross costs.
Meaning TIs and LCs.
LCs and broker commissions.
Okay.
Yeah. So, and free rent. So, traditionally we've seen those consistently be compressed, but we're starting to see a little bit of a leveling around NERs right now. And I think what happened, initially 5 years ago when this dip started to happen in the office space is every tenant is an operating business. They are hypersensitive to their balance sheet. They want to understand what their liquidity position is. So when all this uncertainty was going on, they were very quick to try to push as many costs to landlords as possible to try and induce these deals. And riding the wave of low vacancy for them, they were able to successfully do that. And then you compound that with higher interest rates. The cost to borrow was higher to finance these TIs. And then what a lot of people didn't talk about was materials and labor to build out the space and do those improvements. They were dramatically higher as well too. So you kind of had this perfect storm of costs. And, the last 2 quarters, we've seen our NERs really level off. We're having contractors and we're having tradespeople reach out to us to see if there's, any work that they can take part of. So we're starting to see a real leveling in effective rents, which is usually a good sign that the office market is getting a little bit more competitive for landlords.
Occupancy, of course, is a great measuring tool of demand. What are you seeing on that side?
It's the best. And we've seen our current and committed occupancy consistently climb up, not as fast as we'd like, but it's up 100 basis points quarter over quarter, 50 basis points. It's kind of a slow crawl up. But the one thing that gives me solace is we're expanding tenants. So we have a lot of large tenants, DBRS Morningstar. We recently did a big deal with them.
How big is big in terms of square feet?
A big deal for us by any measure is anything over 25,000 square feet.
Okay.
So we've done a number, I think over the course of the past year, we've done just over 11 deals of 25,000 square feet or plus. We did a huge renewal with the provincial government at 438 University for almost 200,000 square feet, which was a great deal. We did a couple blend and extends with some banks as well too, which has been positive. So we're seeing some growth within the portfolio. Where I take a little bit of pause and why I'm cautiously optimistic is we're not seeing a lot of net new growth. Before 2020, we would see a lot of American businesses, U.S.-led large cap businesses come to Toronto. I don't know if it's on the back of the political environment, but we would see a lot of groups coming to Toronto, touring space. We haven't seen nearly as many because we track the tours and we track the companies. We haven't seen nearly as many large cap or growing U.S. firms set up shop in Canada.
That could be a commentary on many things, let alone just the office environment here in Toronto.
Yeah, good point.
Right? Are you finding the occupiers have made up their mind on how to use the space? Like every time we have this conversation, I use us at First National as an example where, like today is a perfect example. If you walk around the 5 floors that we've got packed, right? And yet if you walked around yesterday or tomorrow, they're empty. And I think our executive team really struggles with that I'm paying for 5 floors for one day. And then of course they're probably, like, let's say it's 90% full today, right? Because we've got a healthy, robust business and lots of staff to fill the desks when they're all in. And it may be at 60% on Wednesdays and 6% on Thursdays and then 30% on Fridays and 30% on Mondays. So like if you do the math, everybody's in twice a week. It's a lot of space for us, the employees to use twice a week. I don't know how you deal it, but I think the answer, if I'm the executive sitting at First National, I go, well, I should pay 2/5 what I was paying before, right?
Yeah.
I know that math doesn't necessarily add up.
Glad that we're not his tenant.
Yeah, I was going to say, but we'd be happy to have First National in our portfolio.
Not in those terms.
Yeah, but it's tough, and where the push pull for us is, and I think tenants are still really trying to figure it out, and the biggest tenants I think are still trying to figure out. Major Canadian banks, the federal government, the provincial government. These are the largest occupiers in the region. And I think they're still struggling with what that ratio of back to work should be, how many days. But what we've seen as a landlord is not so much a major decrease in space. It's just a major increase in the demand for flexibility. So these tenants would typically, and you guys are in the debt space, but these tenants would typically sign 10-year deals. We'd amortize the costs. Everybody would be happy. Now they're working on 5-year deals with an option to terminate after 2 or 3 year deals, or 3-year deals with expansion options after the second year. So I think everybody's kind of waiting and seeing what the plans are going to shake out, but they're really coveting flexibility. And it's kind of traditionally been a little bit more difficult for landlords because, you'd put value on that WALT when you're refinancing. But I think, you're starting to see some more flexibility and people being more amenable to shorter terms.
Well, it's a bit of an invisible cost that gets passed on to the landlord in terms of that, because there's a real risk there.
Good point.
Like I know lenders always hate that when you go, hey, great, 9 years remaining. Ooh, but that clause right buried at the end,
Exactly.
termination clause. Yeah. You are selling in the market, and how robust or tepid is the response when you bring an asset to market? What are people looking for? The deal structure. I mean, outside of price. I mean, there's obviously we're in a price discovery mode with Office, but what do you see in terms of structuring deals when you're trying to sell assets?
Yeah, that's a great question, and even us as asset owners are still trying to kind of figure out what the market looks like. There hasn't been any big sizable trades throughout the market. You hear of assets coming online, you hear them being taken off. I can only talk about our experience. So without getting into too much detail, we have a pretty large building that's tied up right now. We had surprisingly good bid depth for that building. And then we just recently sold a smaller sized building, sub $40 million. And we kind of saw that in that snack bracket, you're seeing a lot more capital that isn't on the sidelines. So you're seeing a lot more private high net worth owner users that see a bit of a low in the market right now. And, a lot of people in Toronto have made their money on real estate. Their families made their money on real estate, and they've grown a business out of it. So they're looking at that kind of sub $40 million range as an opportunity to get in. And without getting too specific, because we're still working through the transaction, but we had really good bid depth for that sub 40. And we've got a couple of other properties that are in the market that the brokers are doing a really good job on and drumming up some interest. But I find it's kind of that sub 40 million. Anything over that, we find it's a little bit lighter.
Cap rate range?
So it's tough to say, but we're seeing anything for good quality product probably in around a 7 cap. But it ranges from geography. As you guys know, covenant of tenancy as well too plays an impact on some of these. But we haven't seen, and I'm going to be really curious because, you hear, pension funds and institutional owners maybe aren't that long on Office and they have to make some portfolio adjustments and do some sales. It'll be really interesting to see what the outcomes of those sales are and what those cap rates trade at, because it'll have a material impact, I think, on the rest of the landlords and the rest of the market. We just haven't seen anybody unlock or be that much demand for big office yet.
We have to recognize that not all office buildings are created equal. And I think you and your portfolio is probably, you're going to agree, but more on the high quality end of the rest of if you just took all office buildings, as an average. We look at focusing on Toronto, but I'm sure this is true in some major centers. There's still some office development on the go that were decided upon pre-COVID that are bringing still a ton of brand new quality square footage. I'm assuming that doesn't impact other Class A office buildings that are in the neighborhood, but the trickle down that we hear from the Class Bs and of course the Class Cs, it must still be carnage to a certain degree in those spaces.
Yeah, Aaron, not enough. That's a heck of a good point. Not enough people are talking about that. More than a third of the inventory, I think, in Toronto is probably deemed functionally obsolescent by anyone's standards. The base building systems don't work. They're old. They're tired assets. So when you've got these new supply quality assets and there's a flight to quality from
it's affordable.
Yeah.
I remember having these podcasts pre-pandemic, back we talked about in the heyday when Office was still sexy, and we were hearing like $70, $80. Like some guys were saying, you know what, next year it's gonna be $100 NER to rent downtown Toronto. And I think it was Tim Hortons that was. They were doing tours. I don't remember the details of what happened. Maybe you do, but they were looking at big chunky rents. I don't know where it is now, but it's not $70 or $80, right?
No, but it's still really high. You know, you hear of the Scotia Plazas of the world and the CIBC Squares. These are incredible buildings. And I think there's a lot of companies out there that covet quality and covet amenity offerings. And I think buildings like that will always capture good.
So what are they
tenant fees.
getting? Like 40, 50?
Oh, I think it's north of that.
Oh, is it?
Yeah,
Okay,
I
okay,
do.
that's good to know.
Yeah, I think it's still pretty healthy.
And not to lose track of the conversation about the B's and the C's. My point was back then, everything was being pushed up. So like maybe you couldn't afford the 70, 80, you were paying 40, 50 or 60, and that was a class B. Now all of a sudden you can move out, right? So
100%. But people got to realize too that class AAA vacancy rate is sub 3%. Like those buildings are full, and the type of tenants that go into those buildings don't mind paying
banks,
for quality.
law firms, accounting firms.
Correct.
They'll
Right.
sign longer leases. Well, I was gonna say then, if you're even in the B class stuff and you maybe lower, the net effective rent is still in the $40-$50 range. It's not the rents that are killing them; it's the vacancy, which all gets pushed down onto them. You can fill your building. I'm sure you can sustain your asset at $40-$50 net. 30% gaping hole in your rent roll. That's what's going to kill you.
Well, where are rents now for that sort of B class? I mean, maybe define that. Like, what would a B class office be in your mind be like outside of the using GTA for those of us that are all center of the universe here? That's kind of outside of the Bathurst, Bayview, Jarvis sort of corridor, and maybe it's north of, we talked St. Clair, maybe it's north of Eglinton. I mean, I'm sure if you're on Yonge Street, probably you can justify that being
such a downtowner.
Yeah, I know. Sorry. But, define it to me, because you're not talking about like Aurelia as B class.
No.
What's the B class to you?
Like I think a typical B class office building, you could probably expect to see anywhere to the mid to high 20s,
Okay.
low 30s, kind of in the fringe core that you're talking about. Net effective rents kind of in the mid to high teens are kind of what we're seeing. We have some B class buildings as well too. They've leased relatively well. We've made big capital investments in them. So they've leased relatively well, but that's kind of where we're seeing NERs for those.
Where are the brick and beam buildings that are kind of core but not AAA class?
I think there's some headwinds traditionally in the brick and beam, and I think the issue right now with that is traditionally it's been a lot of tech firms. And, when we're touring tech tenants, you often hear that VC money's drying up a little bit, investment in some tech, non-AI has dried up a little bit. So I think a lot of those brick and beam buildings have felt some of those headwinds. We own a class of building that we call boutique luxury, and we own a whole block right at the corner of Adelaide to Richmond. And those buildings, just before COVID hit, we invested about $50 million, so on 500,000 square feet. So we hired Paulo Ferrari from the Four Seasons, does work for the Four Seasons, to design it. We built these beautiful, Manhattan-style low-rise buildings, fit them all up, and created this asset class. And we're seeing great rents. Like we're doing rents in the 40s, the high 30s. Where we, I think, really have won the day. And
Those are the tenants that are too cool to rent space in CIBC Square.
Yeah, they want to be beside nerds like you.
Still want the luxury and the value.
Well, what helps us with that is our average floor plate on there is 5,000 square feet. So if you're a tenant at a big tower like Scotia Plaza or CIBC Square, if you're 5,000 square feet on a huge floor plate, you don't have a huge presence. You walk off the elevator here, you're a boutique law firm or a fund manager, you've got your own floor. You've got a Bay Street address. And I think our team's done a really strong job on the retail. We put Milos's first restaurant in Toronto at the corner of Bay and Adelaide. We just recently did a deal with Adrac. We have John & Sons, Cocktail & Co. We're putting in a new Starbucks. So it all kind of builds this ecosystem. And not to forget Daphne. So Daphne's a restaurant that...
Fantastic restaurant.
Yeah, thanks. Yeah, so we partnered with Charles Caboth and the team at Inc. And we've built a great offering there. And people really enjoy going there. They want to be in a building that's near there. And we've tried to really build this kind of boutique offering that just traditionally hasn't been in Toronto.
I would be remiss if we didn't bring up borrowing, because of course we are lenders. And I'll use apartments as a proxy, because in the apartment space, the borrowing cost of, a REIT versus, kind of mid-sized player, the gap is there, but it's not enormous because, the government insurance. the risk profile in office being pretty dramatic, the borrowing cost of what you can do versus like a small operator on an office loan has got to be quite wide, which will give you a bit of a competitive advantage. Obviously, that interest rates are partly what determines cap rates, and if you can, of course, borrow at the bottom of a wider range, there it is to your advantage. When you're out for looking for debt, I guess it's no secret that, of course, not all lenders are in that space. So, what are you finding an appetite for it, and any kind of risk mitigants that are showing up?
Yeah, that's a great question, Adam. So
You don't do unsecured debt, or is that? Are there too many dream entities? Sometimes I can't keep track. Sorry, don't take that personally.
yeah, we've looked at every different
Okay.
kind, and we've worked in a lot of different facilities. Over the course of the last 5 years, renewing, we're very lucky. We've got great partners. I'll start by saying that we've got great partners that have consistently been there for us, and that have helped us out. And I think we've gotten really good. I think Saring and Jay Jang, our CFO, have done a really good job maintaining those renewals and refinancing our buildings. But we have seen over the course of the last 5 years kind of a real aversion to office, and I've never seen so much scrutiny by lenders on office space in the 22 years I've been in the business, from covenant reviews to capital spend reviews to walking the buildings to monthly cash flow updates, and there's been a real scrutiny on it. So I think we've had to get creative. We talked about having older buildings. We have a couple B-class buildings. And we've gone away sometimes from our traditional lenders and have had some success working with governments. So we partnered with the Canadian Infrastructure Bank. We got a $136 million facility from them to decarbonize our buildings by 40% over the course of the next 5 years. And when we do that and we hit those hurdles, our borrowing capacity is sub 2%. So they've been really good. It's helped us finance a lot of really great improvements. And then that lowers the utility costs, that lowers the additional rent for the tenants. And at the end of the day, the tenants look at the gross rent, the net rent, and the additional rent. If we can stay more competitive on a per square foot basis by decarbonizing our buildings and lowering utility costs, then we're in really good shape.
How does that sort of ESG initiative impact sort of fundraising, your capital?
Yeah, so that's interesting. So it's kind of mixed. Western European investors, when we talk to them, a lot of European investors, it's front and center. And ESG you got to be careful with, because if you get every accreditation that's out there, you might actually bankrupt your company. There's so much, and there's a lot of risk around governance and things like
Reporting
and everything. And for us, I think we've been very pragmatic. We think doing the right thing for the environment and sustainability is important. So we've kind of worked hard to try to align that way. It's very difficult. I get a lot of questions around ESG, like what's the return on costs, or what return metrics do you use when you're investing in the space? And it's tough really to kind of put a number on these things, other than the fact that, it helped us get a facility like CIB. We worked with our partners at another building to get a sustainability linked loan that lowered our cost of debt by a few basis points as well too. But I will say the Canadian government has been front and center in this space. And one example I can give was we have a net zero community, fully net zero in Ottawa. And the federal government had a public tender for office space. And usually it's a race to the bottom with the federal government. And the lowest tender wins. No matter what the price is, that's the price that's fixed. They're your tenant for 10 years. We were the highest rent and the most expensive offering by, I think, 35%. But we checked every box. So just before the Treasury Board of Canada came out and said, every single public accommodation for the federal government has to be net zero by 2035. So we hit every box. We had a building that was net zero. We signed a partnership agreement with our First Nation community on the site. We had a social procurement policy in there, and we were 35% higher on a net rent basis than the next proponent. And we won the bid. And at the end of the day, they said, you guys checked every single box that we had put as a public disclosure, so we couldn't say no. And
There's a cost to that.
there was a cost to that, but we were already building the infrastructure well in advance.
No, I mean, the government is recognizing there's a cost to their needs, right? To meet all those things, they have to pay up for it. And
100%.
I think that's what you're getting at.
Yeah.
Well, we've debated numerous asset classes. Yeah, the quantifiable lifting rents for ESG initiatives. That's a great example and a very big number.
Yeah.
I mean, I'm sure you did some math on measuring the return on that additional rent and what it cost you in terms of what you had to put into the building. That's how you squeak out value in the space.
100%. And the type of tenants that do value that type of program are typically a little bit more sophisticated and well capitalized as well. So they'll often invest in their fit up or in the building program to kind of support their ESG goals. And one thing we do at Dream as well too is we white paper all our output, all our data around consumption, waste, and then we provide it to our tenants so they can use it and show what impact their accommodations is having on the community.
Let's pivot to amenities. And this is one of those things that we've talked about.
Aaron loves this topic.
Yeah, well, I do and I don't. Like, it's one of those things where we talk about it a lot, and I think there's some really great ideas. And as a user of office space, and I'm in the office 4 or 5 times a week, a lot of these things I'd love to have in my building, and yet I don't ever see them coming. So
Foosball tables?
well, no. Well, yeah, that would be great. Who was it? I always forget his name. Hutchison. Scott Hutchison
Alpine.
at Alpine. And he was talking about what they're doing in some of their office buildings in Calgary, where there's, basketball courts and all sorts of stuff that's just, if you're a tenant, you get it. And he was very optimistic about how this is the future of office. I think that was pre-COVID, if I remember correctly.
Yeah, somewhere in that mix. Yeah,
Might have been.
Because they had obviously had office problems that market that well predated COVID, so they were already looking to attract tenants.
Yeah, maybe
in
that's
2018,
true.
19, when I'm sure you were enjoying, a tailwind like none other for the portfolio. It's
And to be fair, we always kind of learn lessons from the U.S. I think in the U.S. there are some markets where the amenitization of office has really occurred, where there's some really cool opportunities. We haven't really seen it here. I understand there's a whole slew of fundamental challenges right now, but what are your opinions on amenities for office buildings?
Yeah, we haven't. I think there's traditional amenities where you see, free fitness. You build out a weight room. There's a nice quiet room. You build out a prayer room. There's drop-in meeting spaces. There's a game room. You can play video games or foosball. I think all that stuff's low-hanging fruit. Where I think we've had some success in the REIT space and against our peers is we've got this really cool social amenity offering. So like I talked about a little bit before, we have a program called Social Procurement, and we work with our clients and our tenants on it. But effectively, we provide 20% of our contract awards to equity-seeking groups. And it makes a real impact, and people like to see that, and people like to know that their construction dollars and their maintenance dollars are going to support that part of the community. So we work on that, and it's the right thing to do. The other thing we do is on social amenities is we've got all these great restaurants. We own the Distillery District. We own incredible restaurants on Bay Street. We offer all our tenants discounts, first come opportunities to hold events at these different locations, and that's paid real dividends for us as well too. And then we do a lot of community. We've got a community ambassador that goes around and will help facilitate, like yoga classes at Adelaide Place, things like this, and more connectivity, books clubs. I think those kind of social amenities have really helped us.
I think we're running out of time here, and I don't know if the mics are picking this up, but the social element of the
It's getting loud.
Yeah, it looks like the drinks are going here. One last topic. It's the noise to signal ratio has been enormous. Office conversion. Everybody's talking about it. Like, you can snap your fingers, make it happen. But I'd be hard pressed to point at 5 projects that I know of that are actually underway. I'm sure you've looked at it in your portfolio. What are your thoughts on viability, especially given that you're in a number of different markets?
Yeah, so good point on the different markets. So it's still quite difficult in Toronto to make it work, and I think
From a physical perspective. Right?
perspective, and we've done the studies on all our buildings. Calgary, for example, is the municipality is very proactive, providing subsidies and abatements to help the pro formas work. So we're part of the program for one of our locations in Calgary, one of our core locations. We'll make an announcement next quarter. We're going to be working through a conversion in partnership with the municipality. I think it's still tough in Toronto. I don't mind saying here, we actually had a conditional deal to convert a suburban property into residential, and it was tied to a private college. And what had happened, unfortunately, is when the federal government made the announcements around the cap on international students, that side of the business unfortunately took a huge hit. And we were getting inbound calls from private and public colleges around student residences and micro units. So we were actively trying to figure them out for our downtown office buildings. But as soon as that announcement came and the headwinds we're kind of seeing around immigration in terms of numbers for the future, I honestly think the commentary and the conversations around conversions have gone down quite a bit in my space. So I think there is a tie-in to that. And just from personal experience at work, it affected one of our projects.
Well, I mean, the other factor in play, of course, is, you're saying that the office market is improving, which would therefore notionally increase value. Mm-hmm. So if you're using the base building cost in your conversion pro forma, that cost is going up and up and up, which fights viability of going ahead. If office values rebound 20%, well, that could push a whole lot of conversion projects into the unviable category.
100%.
So, yeah. Mm-hmm. So I think this will be a moment in time where we spend a lot of time talking about office conversions and saw very few.
It sounded cool.
Yeah.
And so it got a lot of cool headlines and a lot of people talking about, this really neat concept. And it makes sense in theory. You've got the buildings, you just throw some bathrooms in there and make it a bedroom instead of an office building. Like, why not, right?
And there's only 2 elevators and, you're crammed in there. Like, it's not as easy as it sounds.
But that's, I think, the reality, right?
Yeah. But as you highlighted, I mean, you obviously you looked at it for a number of your buildings. You are going ahead with at least one. Mm-hmm. But it also means you had a whole lot of projects a whole lot of buildings where it did not make sense, right? And this is a large portfolio. And I imagine other groups that have large office holdings did the same math, came to the same conclusion. Okay, no, we're not going to snap our fingers and become giant apartment landlords.
Yeah, no, you're right.
Yeah.
Gordon, I think we're out of time. The drinks clinking behind us, that's our cue to call it. So,
and it looks like we got a long lineup to get there.
Yeah. Want to thank Granite REIT for sponsoring the speaker video series. Thank First National powering the podcast. Of course, thank Gord for coming back on. Really appreciate it.
No, my pleasure. Thank you both. That's been very helpful. Thanks.